Thinking about relocating to a new state, maybe for work, for retirement, or a lifestyle change, and wondering how to buy a home while you're still living hundreds of miles away? As a mortgage lender licensed in Washington, Oregon, California, Idaho, and Arizona, I've helped tons of relocation buyers make this transition smoothly, and I want to share some tips and tricks on how to save you time, money, and stress. So with that, let's get into what it looks like to relocate with a home purchase. So first, step one, of course, is to get pre-approved. If you're starting to look for properties, I would recommend just hit the brakes for a second and get pre-approved. This is the first and the most important step. Get clarity on your financial picture and overall qualifying. As a mortgage lender, we go through your assets, your credit, your income, verify your financial picture as a whole, if you qualify for the sales price you're looking for, and exactly how we would need to structure it. One of the biggest variables when purchasing a home, especially as a relocation buyer, is going to be your income. You have to understand, based on your personal income situation, how things need to be structured. So if you are a W-2 employee of a company, you get W-2s on a yearly basis, you get pay stubs every 30 days. This can get dicey with relocating because we need to verify a few variables. First off, are you going to be getting a new job at a new employer when you make the move across the country? Or are you going to be staying at the same company and then just essentially transferring to a new location, different working site? Or are you potentially a remote worker to where it's very straightforward? You can work with the same company, the same role, you can work remotely, so the location doesn't matter. And also with your job as a W-2 employee, are you making a salary, but then also making some bonus, some commission, some overtime income that might change due to a new location? If you are planning to get new employment in a new state when you're looking to relocate for a purchase, what we would do is verify your 2-year work history up to that point. And if you have a job offer letter from your new employer, we can pre-approve you based off of the stated income on the job offer letter. And in some scenarios, we can close on a purchase without you having to receive your first pay stubs. If you are self-employed, this can add another wrinkle into determining if we can use the income or not, because with self-employment income, we essentially look at the past 2 years of work history, the past 2 years of federal tax returns. In most cases, we look at the net income number for qualifying for a mortgage. We average that out over a 2-year period, and based off of that calculation, that is the assumed qualifying income that is expected to continue for at least 3 years after the mortgage. And so with your self-employment business, if it is location specific, we would have to be able to prove that that same income is likely to continue at your new location. And so if you were, for example, a contract worker to where you had a guaranteed contract that you were self-employed, but you have a guaranteed contract through another company that is set to continue at the new location, then there's an argument to be able to use that income. But if you have a self-employed business that isn't guaranteed to maintain the same amount of income somewhere else, then there could be issues with using that income at all. But with like the W-2 situation, if you have, for example, an online merchandise store to where it doesn't matter the location of where you're currently living, you can make that income wherever, then we should be able to use the income for qualifying on your relocation purchase. Some various other income scenarios to consider are if you are making retirement income or pension income, Social Security income. Those types of income are likely to continue because they're not dependent on current working situations. They're typically post-career income sources, which are fixed amounts, which we should be able to use on the purchase. One other income source that you might benefit from is rental income. So if you have additional investment properties or second homes in various other states, or even currently where you're moving away from, if you're going to maintain those properties, then we could add in the rental income that you're making from those units to help you qualify with the relocation purchase. Something else to consider is if you are going to be selling then buying, and what exactly the home selling process might look like for you. When we're looking at qualifying you for a relocation, we have, first off, of course, we'll want to look and see if you'd be able to qualify for both of these mortgage payments without having to sell your current residence. We're trying to make things as easy as possible for you on your move. And so if you can qualify for your current mortgage, the new relocation purchase mortgage, and you already have the assets for the down payment on the next purchase, then that's clear cut. But if you can't qualify with both the current mortgage that you have as well as the new potential mortgage, then that's where we would have to make the purchase contingent on the sale of your current residence and that mortgage being paid off. Or you might not be selling a property at all. You might be buying a second home or an investment property in another state, in which case the loan terms for a second home or an investment property differ from a primary residence. So make sure to reach out and connect, and I can walk you through those differences. Once you have been pre-approved, once you understand the full financial picture that you're looking at for your relocation purchase, then that's when you want to start learning the new local market. Connect with your realtor and your lender to understand the differences in the area that you will be buying in. Property taxes and insurance can vary widely from state to state. For example, I live up here in the Pacific Northwest in Washington. Property taxes in Washington and Oregon are relatively high. We're talking ballpark 1% of the sales price is the annual property tax amount. So on a $500,000 purchase price, you might be looking at $5,000 in property taxes on a yearly basis. But then the property taxes down in Arizona might be a third or a quarter of what property taxes up here in Washington are. There can be a big difference. If you're up here in Washington compared to Arizona, there might be various flood zones that you have to consider with flood insurance. In California, the property insurance might be higher due to the fire hazard. And when you're out looking at properties that you're considering offering on, make sure to reach out to your lender. Just send them the property address you're considering. They can look up the accurate property taxes, the estimate for the homeowner's insurance, and give you an accurate quote. If you're not wanting to go contingent on the sale of your current residence to purchase your next property, but you're still wanting to have access to some assets for a larger down payment, but you don't want to pull from an investment account, there might be options to tap into your current home equity, either via a HELOC, which is a home equity line of credit, or another bridge loan product to help make that transition a bit easier. Or you could look at completing a recast after the fact. And what a recast is, for example, if you don't sell your current residence, you just end up buying a new residence somewhere else. You can take your time to sell your current residence. Once that home is sold, let's say you have $500,000 of equity or of net proceeds from the sale of that property. In most cases, and you would have to verify this with your lender before closing on the next purchase, you can typically complete one recast. And essentially what a recast is you take that $500,000 chunk that you want to apply towards your new purchase loan. Let's say you got $1 million loan balance on your new relocation purchase. That $500,000 from the sale would be applied towards that new loan balance. It would then be re-amortized over the remaining loan period, and your new monthly payment would be affected accordingly. Essentially, when you purchase a home using a 30-year fixed mortgage, you can't change any of the loan terms over that entire period, the 30-year term. But by utilizing a one-time recast to be able to pay down your principal balance and re-amortize the loan, you're able to effectively get around that. As I mentioned, it does vary depending on the lender, so reach out to your current lender and make sure that you can make this happen. If you're looking to relocate to a new city or a new state, the process doesn't need to be stressful. Make sure to find the right lender and realtor team to help guide you throughout the process and just enjoy the ride. If you have any questions whatsoever, make sure to reach out and connect. You can visit lenderconnorweb.com to do so, and make sure to like and subscribe to this YouTube channel for more mortgage and real estate content. And with that, thank you for watching, and I'll see you in the next one.